The first management on our show is Northern Arc Capital. We have Ashish Mehrotra, who's the MD and CEO of the company, joining in to discuss the business outlook, more importantly, the FY26 outlook as well. Ashish, thank you so much for joining in. A two-part question, one on the demand side and the second on the supply side. On the demand side, the street is believing that credit growth remains a little weak in terms of offtake, etc. How have you seen that, and what's your prognosis for this year? What sectors would lead it, and what sectors would you not lend to this year because of asset quality issues? And second is the supply side. I mean, with the rate cuts coming from the RBI, one believes that the cost of deposits or the cost of funds will reduce. Would that be margin positive?
Hey, hi, good morning. Delighted to be here. I think you kind of rightly picked it up. The demand tends to be slightly muted. We're seeing some of the sector where is some amount of correction being made, especially in the MFI side. We saw that the guardrails being implemented. We're seeing some early signs of improvement. To my mind, it will take a quarter or more for it to stabilize. I think MSME is grossly underserved. It contributes significantly, if you look at it, in parts of our GDP, almost 29%, 40% of exports, 270 plus million employment. But 70% of them have very limited access to formal credit. And I think that's where we believe there is a big demand coming in. Consumer tends to be, which is predominantly consumption-led, should have a steady state demand. We saw some bit of rationalization of that demand over the last few quarters or over the last year or so. But I think it will remain robust as we look forward. Our sense is, the rate cuts, the benefit will start trickling in as the MCLR get reset. You can see an improvement of 30 to 40 basis point by the end of the year, reflecting in the better quality NIMs for institutions like us.
All right. Hi, Ashish. Good morning. Good to see you, Ben. So in terms of a growth, if you could help us out, what are you looking at? And if you could give us a band on the margins as well. As you're saying, I think you have more than 60% of your borrowings from banks, right? How much of it is on floating? How much of it is fixed? And in turn, what does it mean on the NIMs?
I think we probably have, if you compare us to our peers, have probably one of the best liability franchise. So we have 30% coming from the global multilaterals, which is largely the offshore borrowing, which tends to come at a marginally better price and for a longer tenor. About 70% comes from the domestic institutions, and large part of that is floating. That is predominantly floating. Okay. So we should see that benefit coming in. We see the rate cuts and the implication of that as a consequence of that reflecting in MCLR tends to follow a little bit of a delayed approach. That's why I'm saying 30 to 40 paisa by end of this year and another 30 paisa plus next year. I think that's where we should see the flowing in as far as cost of funds are concerned.
All right, so 30 to 40 basis points improvement in NIMs by the end of this year and another 30, 40 basis points by the end of next year as well. Ashish, we didn't get the growth question.
Come to that.
Yes, please go ahead.
We should look at between Q2 and for the rest of the year growth coming back. We've seen calibration in MFI. We've seen calibration in the consumer and some of these other sectors. There is a big demand which needs to be addressed. Like I spoke about MSME, there is a massive demand. We have full suite of products between secured, working capital. We have our own funds, which we called emerging business funds, where we deploy. I think we are pretty confident of anywhere between 22 to 25% growth as we look forward for this year.
And on a follow-up to that itself, and
allow me to finish one more part.
Yes, please.
Please go ahead.
Yeah, and plus you should see improvement in NIMs because for us also the expansion of the retail book, that should add further to the improvement of NIM. So this NIM improvement is not only coming on account of cost of funds, but also come on account of the book and the build out of the book in that retail segment.
So just to confirm that over the last 3 years, your NIMs have increased from 5.5% closer to 8.3%. Now you believe that another 30-40 basis points improvement comes in on the back of cost of funds. And how much more comes in on account of your mix change, and
We should
what?
see another 30-40 improvement. So we should see 50%, 50 to 60 basis point improvement in the NIM
So
by end.
closer to between 9 to 10% is where your NIM should sustain?
Actually, if you look at a NIM on an aggregate basis, a NIM is about 9%. And you add the fee income, we have a probably very unique fee franchise coming on account of a funds business and a very powerful placements or a credit solution business where we provide credits to the both domestic and global multilateral product, which is a placement business of ours and a bonds platform. We make about 80 basis point of fee. And as we continue to build the fee franchise, I think that you should see over the next couple of years improvement on that. So your loaded NIM, which is currently at about 10% on a last year, if you look at it, we should see improvement as we go forward on it on a year-on-year basis.
Okay, all right. What about asset quality, sir? Before we let you go, we must talk about that. Are things easing out? There was a fear a few months or so ago. That seems to be receding a little bit. Would you agree? Or do you think we still require a couple of quarters before we're out of the woods?
I think we are seeing signs of improvement on X-bucket delinquencies, including in the microfinance book. While we don't have a very large exposure on it, we have a very small exposure on balance sheet, but that's a good indicator to how do we see demand and the performance on the credit demand from bottoms up chart if you start looking at on a product continuum basis. While the credit cost in Q1 may remain marginally elevated, my sense is H2, you will start seeing improvement in the credit cost.
So if you could quantify that, because last year your credit cost was 3.2% annualized.
Yeah.
Where does that number settle at by the end of this year?
So last year, credit cost has an element of an accounting adjustment, which we had to do on account of taking for the DLG and obviously an overlay. Our sense is if you remove both of them, we were at 260 basis point. On a forward-looking basis, if I say, I think we should hover between 250 to 280 basis point around that.